All right, let's talk about something that goes way beyond spreadsheets and algorithms. We're talking about a feeling. You know the one, that stubborn, gut-wrenching reluctance that costs even the sharpest investors real money. And I'm willing to bet you felt it too.
Just think about it for a second. We all have one. That stock, maybe that plot of land. You know deep down that the value just isn't there anymore, but the pain, the regret, that feeling that it's still part of you, man, that is incredibly real. It's the phantom limb of your portfolio, and it hurts.
So what is going on here? Why do we cling to a sinking ship when we know, rationally, we should just jump? Well, the answer isn't in some dusty old finance textbook. No, it's deep inside our own heads.
To really get to the bottom of this, we need to step away from the trading floor and into the world of psychology. Turns out, there's a really powerful cognitive bias at play here, and scientists have known about it for decades.
It's called loss aversion. This idea was pioneered by the legendary psychologists Daniel Kahneman and Amos Tversky. And what they discovered is that our brains are basically hardwired to avoid losses way more than they seek out gains. Think about it this way. Finding a $20 bill on the street feels pretty good, right? But losing a $20 bill? Oof, that feels so much worse.
And when you actually look at the math, it's pretty staggering. The emotional sting of losing, say, 1,000 shillings feels about twice as intense as the joy of gaining that exact same amount. This simple, powerful imbalance has huge consequences for how we handle our money.
And here's the kicker. This isn't just some interesting little quirk about being human. It fundamentally warps our logic. It makes us do things that are completely irrational from a financial standpoint, all in the name of avoiding that supersized feeling of pain. So how does this actually play out in the real world with our investments? Well, it leads to one of the most common and costly mistakes you can make, holding on to a loser for way too long. This is where the trap gets set.
See, we convince ourselves to live in the land of the paper loss. As long as you don't sell, that loss is just theoretical, right? It's on paper. There's still hope it could come back. But the second you hit that sell button, it becomes a realized loss. It's concrete, it's permanent, and it feels like admitting failure. Our brains will do almost anything to avoid that.
And this is where the whole mission changes. Suddenly, you're not trying to make a profit anymore. Your entire goal, your obsession, becomes just getting back to even, just getting back to zero. We've all been there. You're not investing now. You're just trying to prove you weren't wrong.
This is a perfect example of the real-world cost. Imagine an investor buys some land, and it just sits there. It's not appreciating. They know they could sell it, take a small loss, and put that money into something with real potential. But they don't. They hold on, paying what you could call a regret tax. They're sacrificing actual future gains just to avoid the pain of admitting a past mistake. Okay, so if this is some deep, hardwired bias we all have, how in the world do you fight back? Well, the good news is you can. There's a clear, actionable strategy you can use, and it really just boils down to two simple steps. The first step is all about making a plan with a cool, rational head before things get emotional. The second step is about changing your perspective when you're right in the thick of it. Let's break them down. Step 1 is the pre-mortem. Think of it like an escape hatch you design for your future self. It's the opposite of a post-mortem, where you analyze what went wrong after a disaster. Here, you anticipate failure and plan for it before you even put a single shilling in. You literally write down, these are the exact circumstances that will make me sell no matter how you feel in that moment.
For instance, your rule could be as simple and clear as this. It's an emotion-free trigger. When that number gets hit, you don't have to think, you don't have to feel, you don't have to hope. You just execute the plan that your past, more logical self already made for you. You've pre-committed to being rational.
All right, step 2 is a powerful mental shift, a little mind trick. Stop thinking of selling a loser as taking a loss or admitting failure. Reframe it. You're not retreating. You are conducting a capital rescue operation. You are liberating your money from a bad situation so it can be redeployed somewhere better, somewhere with actual promise.
So let's bring all this home. What's the single most important thing to remember when you start to feel that familiar dread of a losing investment creeping in?
Here's the hard truth of it all. The market is completely impersonal. It has no idea who you are, and it definitely doesn't care what price you bought in at. Your job as a smart investor is to get your feelings out of the driver's seat. You have to make decisions based on future potential, not on past regrets.
It is time to let it go. Selling that loser isn't failure. It's freedom. It's an act of liberation.
You're freeing yourself from that constant nagging pain and giving your capital a chance to have a new, much more productive life.
And that's really the question I want to leave you with. By keeping your money trapped in a dead asset just to avoid a bad feeling, what incredible opportunity is it missing out on right now?